Now, here's the deal. You need to get the full picture on investments all at once. Oh, how many of you read the appendix on it? The appendix chapter, that investments chapter. That's next, right? How many of you read it? Yes? Okay, sort of? Anybody else? Oh, okay. I mean, that's a really horrendous mistake, right? I know you just did a quiz, but how'd you do well on this quiz? You jumped on it, right? So let's do it with this stuff. So before I see you today's Friday, right? Before I see you Monday, get this chapter read. Maybe get the next one read. Do a whole bunch of homework. Get out the practice quiz that I gave you, which has problems just like the ones we're going to try and do. I'll get through part of it today, and the rest, I have another day on it, right? On Monday, on this chapter. Right? This is a big deal. It's a big chapter. I know it says appendix on it, but it's really a tough chapter. Okay? There's a lot in there, and it's things you really want to know. But you can get this compartmentalized, set up so that it makes sense. Okay? If you try to memorize this chapter, your brain is going to explode. If you try to understand it, it's not too bad. Okay? Because there's always a why here, right? The nice thing about accounting is there's always a why do we do it this way. And if you understand the why, you got it made. If you don't, it's really rough. It's really rough. It's just like, what are they doing? I can't memorize all this stuff. Well, I'm not supposed to memorize it, right? It's common sense, kind of, after you understand, right? It's understanding the business transaction. Okay, so what do we have here in this chapter? The two of you that read it. And what do we got in here? These are investments in other companies. What do we invest in for other companies? Their stocks and their bonds, right? So what you buy. Do you guys already know how to handle investment in held-to-maturity bonds? Yeah, that's where we're holding to maturity. If we're holding it less than to maturity, you know, for a few days, maybe a few years, right? If you're holding it for a lower period of time, you account for it differently because it's different for you, right? You wouldn't record the premium or discount and then amortize it over the life of it because you're not going to hold it for the life of it. Make sense? Okay? So just on that one. When I invest in another company's stock, of course, that's their equity. What is it to me? An investment, which is a asset. How do you increase all these investments? Assets. Debit. How do you reduce them?
Credit.
Credits. Big deal. What do you bet you earn off of these assets? You might have interest revenue. You might have dividend revenue, right? They pay a dividend to me. For them, a dividend is a reduction of the retained earnings, right? For me, it's dividend income, right? That makes sense? For them, it's interest expense. For me, it's interest revenue. We already know that, right? Okay? This is not a big deal. What's the other thing that can happen? They can increase and decrease in value, which would be what? An asset that increases and decreases in value, and it is not in the normal course of operations, which means it's not sales and expenses, right? It's not part of that. It's not part of operating income. What is this stuff going to be? What are the other two things we have in the income statement? Kind of like revenues, but there's no expenses with it. What is that thing?
Gain.
A gain. You could have a gain, right? What else could you have, of course? If it goes up in value, it's a gain. If it goes down, it's a loss. I mean, this is stuff you already know. Just relax, okay? Now, what we're going to do is we're going to separate it. That always scares me. Okay, sometimes it does that. Okay, what we're going to do is separate these into categories. Okay? So, I'm not going to write it in. I knew it. Still not going to write it. This one. Come on. There we go. All right. Okay, what we're going to do is separate these into categories. Right? And it's going to be based on two things. One is how much we own of the company, what percent of their total stock in this case, right? How much we own. And the other one is how long we are going to hold it. Everybody got it? Those are the two things that determine how we're going to account for this. What do you guys already know about current assets and non-current assets? Yeah, less than a year is current, right? If I'm going to hold it for less than a year, it's a current asset. If I'm going to hold it for more than a year, it's a non-current asset, isn't it? So we'll have short-term and long-term. Big deal. Okay? All right? So here's what we've got. Let's do percent of ownership first. This is the percent of ownership. And by the way, on the investments in bonds, we have no percent of ownership, right? No control. Okay? All right, so percent of ownership. So let's say that we own at least one share of stock, but not enough to have any sort of significant influence over what goes on. We would call that no control. you guys read about, right? No control. And what number? Did you pick the number? I don't want to put you on the
Wait,
spot.
you said this is for one share?
One share up to however many. Up to what percent? So one share, you have no control if I own one share, up to what percent of the total shares? Outstanding. What's the number? Well, 49 is, I'll have significant influence before that. Over 49, over 50, right? 50 plus, I have total control. I'm going to have three categories. I'm going to have no control, right? Then I'm going to have significant influence in between. Okay? So there's no control, there's significant influence, and then there's control. And you can't tell me you have to memorize that stuff because it's just common sense. It's either control or not, or somewhere in between, significant influence. So what were the numbers? Did you guys pick that up? That read it? Yeah.
I think it's 20%.
Yeah. One share up to 20%. And that's just a rule of thumb. You know what a rule of thumb is? If I don't have any other evidence, right, I'll use 20%. But let's say that it's General Motors. You own 20% of it. By the way, nobody else owns even 1%. You think you have significant influence? I think you're on the board of directors. So you have significant influence. How about if you own 19%? You're still on the board of directors. Ford Motor Company, you own 20%, and you're not a family member. You don't have any control. Probably significant influence still, maybe, right? You got the idea here? So it's just a rule of thumb, okay? But for our purposes, I'll tell you they own 1%. And guess what you'll think? They have no control. And we're going to account for it differently for these different things, right? So it's up to 20%. Everybody got the idea?
But are you saying it's a sliding scale?
Yeah.
Okay.
Yeah. We're going to have different methods for, and they're just rules of thumbs to catch, right? Okay, for control, he's right. Control, when would you have control? 50 to 100%. When we vote, I vote more than 50% of the shares. What do you think? I win. Every time, I win. I like to vote like this. I believe in democracy if I have more than 50% of the votes. What a deal, right? This is what all the Republicans on the little debate thing, right? So they'd like to have. Yeah, so anyways, fine. Okay, watch it. All politicians want that, not just Republicans. If we could just have all the votes, it'd be perfect. Okay, anyway. Well, it's not a democracy anymore. But anyway, yeah. So 50 to 100%, right? Got a compromise. 50 to 100% would be control. Okay, good. And guess what significant influence is? How about 20 to 50? Yeah. Can you guys remember that 20% number? You have to kind of remember that, right? But it sort of makes sense. At what point do you really have significant influence over the company? And 50% is just common sense, right? So I own more than 50%. I win. If I own less than 50%, I don't necessarily, right? But I still have significant influence, okay? All right, good. All right, and then what we're going to do is we're going to call these different things, huh? What this is going to be on the no control is I am going to record these at cost. Everything is recorded at cost. But I'm, at the end of the year, going to adjust to market value, okay? So it's market value. That's a big deal. Market value or fair value accounting. I am going to increase or decrease the investment up to market value if it went up, or down to market value if it went down. And guess what that's going to create for me? I bought it, recorded at historical cost, and it goes up or down. What happened? You have a what? Gain or loss. Yeah, we're going to have to record the gain or loss. That's it. Okay? And what we're going to do is we're going to call these one of three things. Okay? That's an up. We're going to call these one of three things. We're going to call them trading securities. Trading, that's a D, sure. Trading securities, it's one category. This gets a little tougher. And then available for sale. Read this chapter, huh, guys? And I'm not mad at you for not reading the chapter because we're going through stuff way too fast. It's just the way it is, right? But you've got it, okay? You've got to do it or we're going to be in trouble next time, okay? You won't get it. Well, assuming there's any benefit to listening to me bullshit about this at all. But yeah, but it'll be hard to get it. Okay, available for sale in short term, and then available for sale long term. It's not that bad to remember. Trading securities are things I'm ready to trade, okay? Available for sale means I'm willing to trade it if the price is right, you know, that kind of thing. But it's available for sale short term. What does short term mean? Less than a year. Yeah, you got it. Less than a year. Okay, what would available for sale long term be? More than. And by the way, this would be stocks and bonds would go in those categories, okay? Because you have no control with bonds, right, guys? So stocks and bonds go in this category. That makes sense? So if I buy a bond and I'm not holding it to maturity, what is it? Trading security available for sale short-term, available for sale long-term. Okay, so what we got is more than a year, over 1 year. See, this all kind of makes sense? There's a lot here, but it makes sense, doesn't it? Okay? Got to have it make sense to you. Short-term, less than 1 year, but more than what would be for a trading security. So let's talk about what a trading security is. I'm holding it to trade. My intention is to hold it for a really short period of time, okay? Like a day up to a few weeks. Got it? This is a day to a few weeks. This is really a short-term investment. And we're going to account for it slightly differently, right? Because we're going to sell it real soon, okay? We're going to handle the change in market price, the gain or loss differently, okay? That's it. So this is 1 day, maybe, right, through a few weeks. So guess what? Available for sale is what? A few weeks up to 1 year. It's less than a few weeks of trading security. More than a few weeks up to a year, available to sell short term. More than a year, available for sale long term. Everybody got it? And the accounting's going to be really similar for all three of those, okay? So we've got three different things, and this makes this a real pain, doesn't it? Got three already, okay? And then we're going to have two others, okay? On significant influence, I'm going to use, so this is a market value method. Market value method, okay? I'm going to adjust the market value, up or down the market value. All right? In significant influence, I'm going to use something called the equity method because I have an equity interest in the company, I say. I'm helping run the company. When they earn profit, I earned it. When they have a loss, it's my fault too. When they pay a dividend, I paid myself a dividend. Oh. Versus in the market value method, when the stock price goes up, I'm thrilled. When it goes down, I'm unhappy. I got a gain or loss, right? If I get a dividend, I'm thrilled, but I did not give myself a dividend because I don't have any significant influence. Got the idea? That's the theory behind it. So it's going to be dividend revenue payment or dividend income. You can call it either one, right? Dividend revenue or dividend income. Here, you don't have to remember that when you go through the entries, okay? All right? And the equity method, I'm paying myself a dividend. Got the theory of this thing? Because I decided to. You know, I own more than 20%. I don't have a major vote in it. I decided to give myself a dividend. Well, that's not income to me. Where does my income come from? The company making money, right? That's it, okay? So this theory makes a lot of sense. What doesn't make sense, perhaps, is a 20% cutoff, huh? Because it's got to be no control, significant influence, and then control for differences. Okay, all right. The equity method, then, what we're going to call them, instead of trading securities available for sale short-term or available for sale long-term, we are going to call them investment in affiliate, because it's an affiliated company. Got it? It's an affiliated company. But it's still just an investment in another company, okay? Now I'm mad I forgot to bring something to drink. It really pisses me off when I go downstairs and it costs, what does it cost in a machine? $1.50 or something to get something that's bad for you. Versus in my office, I have a little refrigerator with stuff my wife bought for me for 30 or 40 cents that is good for you. What kind of, right? Water. Yeah, annoying. Every time I do that. See how cheap I really am? See how much I love my wife? She's talking about a $45,000 car right now. Seriously? Who in their right mind? I mean, okay. She's beautiful. Yeah. Mind myself. Yeah, okay. All right. Anyway, so. All right. In the end, you die, right, guys?
She's never listened to these recordings.
And I am not, she's never listened to these, are you kidding me? Unless you send it to her, and then she just laugh, by the way. Okay, yeah, but in the end, you die anyway, right? So I'm not going to take it with me, and I don't particularly like my children, so, but I love my grandchildren, though, so I want to leave it to them, so I keep telling her that. Yeah. She's not going to take care of themselves, that's fine. Okay, anyway, so what we do here is we use usually a cost method. We just leave it at historical cost and don't do anything on the situation where we don't control. But we call it a what? I own the other company, I am their parent. You like that? I'm their parent, and they are my, not my child, but my what? Subsidiary. You ever hear of subsidiaries? That's what it is. The parent owns the subsidiary, okay? So they're going to be a subsidiary. That's the name for the company. So it's going to be investment in subsidiary XYZ company. Got the idea? So here it's investment in affiliate XYZ company. Here it's investment in subsidiary XYZ company. Here it's investment in trading securities available to sell short-term, available to sell long-term. Got the idea? Depending on what? How much you own first. That's the first cut, right? And then what? How long you're going to hold it. And where does it matter how long you're going to hold it? Only on what? The first one. You don't have to worry about it everywhere else, okay? So don't mix those up. Just leave it alone. Oh, the method we're going to use here, this is market value method, this is equity method, this one is we're going to consolidate. So 1 second. Good question. All right, on consolidate. Okay, on consolidate or consolidation, what it means is put together. Consolidate, and you guys have vocabulary, right? You know, consolidate, we put it together. What we do is we take all the companies. So imagine you've got a parent company that owns 200 other companies. This is common, right? Humana owns a whole bunch of companies. Yum Brands owns a whole bunch of companies. General Motors does. GE owns, wow, a lot of companies, right? And they all operate independently, right? But they own them all. So then, but what do we mean by own them? They own more than what? 50%. So they run them, right? That's it. They decide who their officers are. They decide what they do, right? They do. They're in control, okay? So what happens here is we put their financial statements all together because they're really just one company. So imagine one company owns 200 other companies. We're going to have 201 companies all put together. We're going to add up all their assets, and that'll be the total assets of the group. That's it. Consolidated. We're going to add all the liabilities. We're going to add all the equities, kind of. Get that in a second, okay? We're going to add all the revenues, add all their expenses. But here's the problem. They do business with each other. And that business never happened because you're doing business with yourself. So we have to do what's called an elimination. And we eliminate all the intercompany revenues and expenses. One company's earning revenue by charging the other company and their related companies, right? Parent subsidiary or two subsidiaries doing business with each other, right? So you have to eliminate all the revenues and expenses of both sets of books. Oh, then there's profit in inventory because one company sold the other company inventory. Oh, no, we can't have that because that's doing business with yourself. We've got to eliminate that. It gets worse. So we eliminate all the intercompany revenues, expenses. Oh, one company can owe the other company money, right? One has accounts receivable for the other one has accounts payable. That doesn't exist, right? It's yourself. So you eliminate all that. How about mortgages back and forth? Oh, you eliminate that. You can't owe each other money, right? Doesn't mean anything. It's all one company. So we eliminate all that. We're not doing that in this class, okay? In accounting 414, it's over half the class. It's just doing this one thing. Now, do you think it's important if you're never going to take accounting 414, which is almost all of you, of course, right? If you're never going to take it, you're going to be a business person. Is it kind of important to know about what consolidation means? Holy cow! Every major corporation is a consolidated financial statement. It says it right on it. All it is they put them together. Big deal. Okay, now the other thing is we're going to eliminate all the equity of the subsidiaries. Why would we eliminate the equity of the subsidiaries? Because they don't exist. Right? Only the combined company exists. The real equity is the parent's equity. So we're going to eliminate all the subsidiaries' equity. And then we're going to have something called minority interest, which is a portion of the equity of all the subsidiaries that is not owned by the parent. You don't have to remember that yet. We're going to do some of this. Okay, I'll show you. And that's not even in the chapter. Stop. And you've got to really know this stuff. So we're not going to get real involved. Each year that goes by, it gets worse and worse and worse. Imagine one company sells the other company an asset. Then they start depreciating it at the higher value. Oh man, you have to eliminate the difference in depreciation. It's just a mess, okay? It's a big job, okay? People make their livings this way. I had a student, it's kind of fun. When I first started teaching, they always give the new professors advanced accounting because it's hard and students don't care anymore. They're seniors, you know how that goes. Well, maybe you don't yet, but you will. Anyway, so you're trying to get them to learn this stuff. So I did advanced accounting with him. This guy learned this stuff. He did fine. He got a job with a big Four firm, and about 5 years later, he sent me an email, and he says, Keith, I'm really glad you forced me to learn that crap about consolidations and advanced accounting, because guess what I'm doing? And I can't remember the name of the company, but it was a Fortune 500 company in Seattle. He says, I'm in charge of the consolidation for so-and-so. It's my job to make sure everything's put together right. You know, it's pretty funny. And, you know, so, yeah. So he's glad to go back to the advanced accounting book and look at it and have a prayer being started. Yeah, so big mess. So anyway, all right, guys. So you got the idea on this so far? Question?
You answered it.
Okay, good. Either that or you forgot what it was, which...
I was asking about the time for the affiliate and subsidiary, whatever.
Oh, these you're holding forever.
Yeah.
That's a great question. Do you think that you're going to invest more than 20% in the company and hold it for a real short period of time and sell it? Are you kidding me? If you bought 20% of a company and you say, oh, I don't want it anymore, you had a real pain selling this. If you just go out in the market, flood the market with the stock, what's going to happen to its value? Crash. It's going to crash and you'll lose a fortune. So you'd have to arrange a buyer for this, right? Imagine if you own more than 50% and you want to sell it. It's a big deal, right? It's a big deal. You don't just sell it. What if I own, 0.5% of the company I want to sell it? They might notice, right? It doesn't matter at all. You can sell it for whatever the price is. It's not going to change the price. Got the idea? Certainly any amount I own, 3 shares or something, right? Or 100 shares or something. What do you think? They don't even know I exist and they don't care, right? So that category, less than 10%, doesn't matter too much, right? They're glad to have the investment, don't get me wrong, but they're not. I can't call up young brands and say, I own 5 shares of your stock. I think you should do things differently. They think I was crazy. I'd never get to talk to anybody in any position of power whatsoever, right? Not happen. Okay. All right, so what we got to do is so we can account for all this. You got it? Okay? So let's give them a shot. Okay? Let's do trading securities. Can I use TS? It's not trading for stock, now it's trading securities, okay? Trading securities. And let's do available for sale. AFS, okay with you guys? It'd be investment in trading securities, investment in available for sale, okay? Typically we would call it. We'll do short term, and then we'll do available for sale, long term, okay? All right. By the way, you guys, the fact that you were doing well in here and you're sticking with this is really a nice sign for your college career and for your professional career. Richard Schrader likes to say, we don't ever teach anybody anything, we just sort. Sort the people that will work from the people who won't.
Weeding them out.
I don't think you're brilliant, any of you. I don't even know what that means. I don't think I'm brilliant. I know that's not true. I don't care if you're brilliant. I know a lot of brilliant people who never did anything. That had high IQ thing, the high ACT score. I don't care what your ACT score is. Nobody cares what it is. Nobody's ever going to ask you. We ask you for getting into college, right? They're going to ask you if I get a GPA, yes, but is that a measure of how smart you are? No. It's a measure of what? What are you guys doing to be successful in here?
Smart.
You're sacrificing. You're working your ass off, right? That's it. That's where it comes from. It's hard work. It's hard work. It's hard work. It's hard work. So you guys are catching on. You're doing it. It's fantastic. I love it when I have somebody come into the class and they get a C on the first test, and the second test they get a D, and then the last test they get an A, and the final they get an A. Yes. Turn it on. Got it going. They're going to be successful. Okay? Turkey into reality, huh? We want to make this class so that everybody gets an A at everything. Of course, it'd be much easier for me. Ask you questions tests with 10 multiple choice questions on them where you know all the answers, and everybody gets at least 90%. Be great, right? At least 9 out of 10. Give everybody A's, everybody to be happy, right? Nobody get a job, but what the hell? Couldn't be happy at that point. Okay, so what do you want to do here? Let's say on January 1st we issue the stock. Let's make oh, by the way, trading securities means what? I'm going to hold it how long?
The day of
The day to a few weeks. Available for sale?
a few weeks a year.
A few weeks a year. Available for sale long term? That's short term. Long term?
More than 2 years.
More than a year. Good. Okay. And then let's say what percent of the stock do we own? Something less than 20%. Okay, so let's say we have a company, XYZ company. And we'll just do common stock. Oh, by the way, this is just common stock. This gets preferred what? Doesn't vote, typically. Right?
These are all common stock?
Yeah, they'd be common stock. Yeah. Okay. Or bonds. or preferred stock. But we could use bonds or preferred stock, but then we don't have to worry about ownership share, right? Because we don't have any voting anymore. So this is voting stock we really care about. Let's say that we have outstanding, you know what that means, right? How many shares are outstanding? So they have outstanding shares. Those are the ones that actually are voting, right? Because there's somebody holding. Outstanding, let's say there's 1 million shares. Okay, and we purchase 1,000 shares. We don't own much of this company, do we? It's pretty clear that we're under 10%, or under 20% rather, right? Okay, so purchase 1,000 shares. The market value at the time we buy is $10 per share. Okay? Everybody got the idea? So give me the journal entries for the three of them. It's going to be really easy, really easy. You can come up with them without having read the chapter, I bet you. What are you going to give them? Cash, okay? Credit cash, every case, right? Cash, cash, cash. Do you guys think that might make sense? How much? It's $10 a share and you bought 1,000 shares. How much? 10,000. Come on, you guys. This is the simple stuff. We've already done the hard stuff, right? It's the simple stuff. You're just doing the entries. Accounting is easy. Understanding business transactions hard, right? Okay, and then we're going to debit something. What did we say we were going to call them? If it's an investment for, a few days up to a few weeks? Investment in what? Yes. You guys are going to get these right, aren't you? 10,000. I don't think this is too hard for you guys. Do you? Really? What if I'm going to hold it for more than a few weeks up to a year?
Well, would you have to specify that short term though?
No, we know trading securities is short term.
No, in your journal entry for,
Oh, yeah. Investment in available for sale.
like you have to write short term.
Right, short term, or we think it's long term. Because on the balance sheet, the short term ones are going to be in current assets, right? Long term ones are going to be in non-current assets. Everybody agree with that? That's it. Okay, so that's a good question. That's a debit, you guys. Should have my debits and credits further, why shouldn't I? Okay? By the way, some of you are still lining up all your account names. Stop it. I drew arrows all over your paper. Don't do that. You can't tell. I don't care. Nobody in real life does. Right? Put your debits to the left, your credits to the right. Actually, computer systems do all kinds of crazy things. They even put all the debit and credits in one column with minus signs and stuff next to the credits. Drives you crazy. Far better separate. So you can tell what it is. Were you one of those people?
I was.
You were too?
I wrote it in the right box, but
Yeah.
I just wrote
But
them
then,
all.
and also you should write your debits first, then your credits. I mean, I give you credit if you don't. You're trying to do it fast. But in real life, everybody puts their debit first. It's on the left. Then they put the credit. And then you don't have to tell people if it's a debit or a credit, right? Because it's debits on the left, credits on the right. So kind of discipline yourself to that, please. And you guys know how a stickler I am for formality, right? I just want to communicate. You make it harder for me to grade. Stop it, right? I might get angry and give you less points just because I'm angry. My wife says she thinks I should always have a glass of bourbon when I'm grading. She gets one and she sets it next to me. It's a little one. It's not excessive. Little shot. But she puts it next to me. One ice cube and the bourbon is just above the ice, right? Well, per drink. Yeah, but anyway, yeah. Anyway.
Do we trust your grading abilities?
Yeah, no. Her point is I'm really too mean. So that'll loosen me up a little bit. I might be a little more generous. I had her help me grade one time for the principal's class. And she says, that's close enough, that's close enough, that's close enough. And I'm like, what the hell? Well, I feel sorry for them. You're too mean. They should have higher grades. So that was the end of that. That was her tact for keeping from ever having to help me grade. I had to do it all myself. Okay, anyway, for 30 years, yeah. All right, anyway. What's this one going to be? Debit investment in what? Yeah. Can you guys do this? Yes. It's just simple, isn't it? You know what you're doing. So the hard thing is determining, what percent is it? And that's not really hard. Just look at it, read carefully. What percent do I own? Less than 20%? Here we are. And then how long am I going to hold it? And I'll put it right in the problem, okay? In real life, you have to figure out what the company's intention is, right? Okay? That's it. Okay. So there's investing, huh? That's investing. That's doing the investment. Okay, so this is investing. All right, then let's say what happens is at the end of the year, the market value, this is the purchase, right? Purchase fee. The market value, let's make it $11 per share, okay? All right, what do you want to do? Because that happened. Oh, let's have more. Let's say they pay dividends of, declare dividends of $100,000. 10 cents a share on 1,000,000 shares, isn't it? Okay? And let's say that they report net income of $250,000. Huh. So they made $250,000, paid $100 out in dividends. You got the idea? And the market value went up because everybody out in the market loved this, right? Company's making money. Okay, so it's $11 a share. Everybody see it? What do I want to do? I have no control here. Did I make the income happen? No. So guess what you do about the income? Nothing. No entry for the income. So for net income, all the way across, no entry. Got it? So don't give me an entry. All the way across, okay? For net income, no entry. Because I didn't make it happen. Whoops, wrote that wrong. No, I didn't. I'm right. Okay. All right. All these we have no control, right? No control. I wrote it right. Made a mistake once. I thought I made one. Okay. Anyway, so what's next? That's the income. What else do you want to do? We could do the dividend. Okay, let's do that. All right. There's $100,000 in dividends. How much should I get? What was it per share?
You said 10 cents.
There's 1,000,000 shares. It's $100,000. I got the 100 by taking 10 cents times it. Clever, huh? Okay. But what is it? If you know it's 100,000 in dividends, you know there's 1,000,000 shares outstanding. What does each share get? 10 cents. Just divide the 1,000,000 shares into the 100,000. Everybody good with that? It's 10 cents a share. How many do I own? 1,000. How much am I going to get? $100. What do you want to do? On any one of these, what do you want to do?
Debit cash.
You debit cash. You received cash, right? Your company received cash from this company that you have an investment in.
This isn't net income anymore, right? So you should do dividends and then,
Yeah, this is dividend, right?
okay.
Here's the investment. No entry, right? And then let's do dividends, okay? Thank you. All right, so dividends, what do we got for dividends? Debit cash, how much? $100. And because we are not running the company, we didn't decide to give ourselves a dividend. We're just taking what the market gives us. What do we have? Dividend revenue, right? Dividend income, dividend revenue. That's it. We've already done this, haven't we, before? But dividend revenue or dividend income, either term is used. It's really income because there's no expenses with it, but that's fine, right? There's no expenses to go with it. Guess what it's going to be if it's available for sale long term? Debit cash. No, it's cash. It's just cash.
You said long term.
Oh, short term. Oh, long term too. I'm sorry. Let's do both of them at once because it's so easy. All three are easy. What is it? Debit cash and credit what? And just take what I gave you. Okay, thank you. Keep correcting me too. First, won't write the debits on you. Okay. All right, dividend revenue. Good. Excellent. Okay, like it? I like that line, don't you? I like the last two lines real well. Okay, then there's one more thing, and there's going to be a little difference on that. What is it? What's left? If it happened?
Market value.
Market value changed. Okay, if the market value changed, I want to revalue my asset in every case for the change in market value. If it goes up, I'm going to increase the asset, right? If it goes down, I'm going to reduce it. What's the stock worth right now? How many shares do I have? 1,000. What's the market value? $11. What should it be? 1,100 in the account, right? What's in the account now? Whoops, 11,000 in the account, right? I'm sorry, 11 times 1,000 is indeed, yeah, 11,000. Should be 11,000 in the account. What's in there now? 10,000. So what do you want to do? Increase it by how much? 1,000. So what I'm going to do is I'm going to debit. This is for the increase in market value, right? That's what happened. It went up by $1. Everybody see that? Went up by $1. Okay, I've got 1,000 shares, so I have 1,000 more wealth, huh? So what I'm going to do is I'm going to debit the account. What's it called? In this case, what's it called? Investment in trading securities. This is too easy. For $1,000, I'd increase it up, right? Okay, increase it up. Anyway, I'd raise it. And credit what? Oh, that's gonna be a little different, okay? Well, let's do the next one. This is gonna be debit investment in what? Available for sale, that's the account that it's in, right? Short term, that'll be $1,000, and we're gonna have to credit something for $1,000. Guess what it's gonna be? I earned an increase in value, it is a gain. If it went down in value, I'd have to credit the account, right? Credit the asset, and what would I debit? Loss, right? So these are gonna be gains, all right? But it's a little more complicated than that, and kind of annoying therefore. Okay? So this one's gonna be debit investment in what?
Available for sale.
Yeah, of course. Okay? All right. So here's the deal, you guys. You didn't sell it. So you have not realized the gain yet. What does realize mean when I realize a gain?
You haven't reported it?
No, that's recognize. Recognize is put it in the financial statements. I recognize somebody, I recognize a number, I recognize a number when I put it in the statement. Make sense? Okay, recognition. So the revenue is recognized when you put it in the income statement. Expenses recognized when you put it in the income statement. Got it? Same with assets, liabilities, equity, realty. You recognize it when you record it. Okay, what's realized mean? Cash change hands. Told you this before. Don't you know everything I said? I'm kidding. Okay, in intermediate, you won't know it either. Those of you are going to go there. Right? Finance and accounting majors. Okay? Realization is the cash change hands. So we didn't sell this. Have we realized it yet? No. So we have a really clever name for this. It's an unrealized gain.
For all of it?
Yeah.
It would be unrealized, but it would still be recognized. Or
Yeah, it's still recognized. Well, the first one's still recognized. The others are sort of recognized, and we'll get to that in just a second. That's what makes this kind of hard. So I'm going to call this an unrealized. I like this for some reason. It's an unreal gain, my abbreviation. You like it? Unrealized gain on guess what? Trading securities. And then the other one, the next one's going to be an unrealized gain on what? And if it's a loss, it'd be a loss, it'd be a debit, right? If it went down in value. You'll read about that. Unrealized gain on what? Available for sale short term. And then what's the other one going to be? Unrealized gain. Available for sale long term. Now, here's the deal. Your question was really good. Isn't this also recognized? Well, kind of. This account right here, unrealized gain or unrealized loss, if it's a loss, if it's down in value, on trading securities goes on the income statement. Ah, it's a gain account on the income statement. Everybody got it? Be down there with the non-operating stuff, gains and losses. Okay? Other revenues and expenses and gains and losses down in the non-operating, right? Okay? This is going to be other comprehensive income. Oh my, and so is this one. And what does that mean? It does not hit the income statement, it goes straight to equity. Okay? So you need to know that.
what's it called?
Other comprehensive income. Okay? Now here's the deal, you guys.
Wait, you said it goes where?
On straight to equity as other comprehensive income. I'll show you in just a second. Okay? Now, here's the deal, you guys. This was a very, very contentious issue. Do you think that assets that are publicly traded, you got an investment in Young Brands, do you think it should be recorded at historical cost or market value in the financial statements at the end of each year? Do we know what the market value is of Young Brands every day of the year? Yes. You can look it up right now. It's being traded right now. It's changing right now. We can get 30-minute-old values for free online. Yahoo Finance or MS Finance. If you want to pay for the values, you can get the value a second ago. Right? You can pay a service to get that to you. They're trading right now. We know what its value is. We know how many outstanding shares they have, and we know what they're selling for. We know what the value of Young Brands is all the time. That's not a real issue. What we really care about is what's it going to do next, up or down. You're making investments, right? I want to big stocks are going up, not the ones that are going down, right? Obviously. Will Rogers had a really neat, he said, old time. Anybody know who he is? That's terrible. Found some stuff by Will Rogers. lots and lots of quotes, really cute stuff. He was a writer and a performer. Anyway, the folksy type guy, really funny stuff. There's a line that was surefire way to make money in the stock market. Buy a good stock, wait for it to go up and sell it. If it don't go up, don't buy it. Get it? That's the game. Don't buy the ones that don't go up. Only buy the ones that go up. Surefire way to make money. Yeah. Anyway, all right. Let me show you this. I know I'm supposed to be done. Here's the deal with other comprehensive income. This is that lie again that I did. I told you this the other day, didn't I? That I lied a little bit. You guys have caught me a couple of times. So it's contra assets, right? Contra everything. Told you there are only 5 accounts, there's really 10, right? Yeah. Okay, here's another one. Equity, I told you so far that we had what? This is going to be the last one, the last category. We have contributed capital and retained earnings. There's one other category, other comprehensive income. Okay, now here's the deal. Everybody wanted to record stock at market value because we know the market value, right? So we know the market value at the end of the year. Shouldn't I recognize the gain or loss on it? Well, yeah, I should. Don't you think? I should record the increase or decrease in value shown at market value. Well, everybody agreed to that, but nobody wanted to show losses on their income statement. Oh, so at first what they said, oh, well, avail for sale long term, it'll recover. Before I sell, it'll recover, so it's not really a loss yet. So I don't want to put it on my income statement and show increases and decreases due to the market variation, right? I don't want to show that on my income statement because it makes me look more risky if my income's varying up and down. Right? Well, it really is varying if the value's going up and down, but anyway, okay. So then what happened was it says, no, the ones I'm holding for almost a year or even 6 months, they'll adjust too. So it got to be more and more in the shorter period. So they created this trading security that's, everybody thought it was going to be maybe 3 months. Well, it ended up being more like 2 weeks is what people use. Most companies just decided not to have trading securities. Because what you're trying to do anyway, right? I invest in it. No, I'm not keeping it just a few days. I'm going to keep it for more than a few weeks, so therefore it's available for sale short term. And what happens is that gain or loss goes in this other comprehensive income category directly. It does not hit the income statement. Got the idea? So on the trading securities, the gain or loss goes in here, right? On the trading securities. On the available for sale, short term and long term, they go in here. Big difference, okay? So I'll leave you with that. Read the chapter and pay attention to that stuff, okay? I'm not going to make a big deal out of it, but you need to know it, right? You need to know it for your clear. Okay, what's going on? See you guys. Keep working, keep working, keep working.